All right, let's talk about the mystery charts and the methodology in action. This was not a mystery chart because I showed it while it was still live, and usually with the mystery charts, I like to show them before they trigger. In this case, it had already triggered by the time the webinar came around. Anyway, the mystery charts so far, I think 100% have come directly from my trading service, and you can find those at daylearner.com/archives. And you can also find them on my YouTube channel. You can find the newer ones on my YouTube channel. Anyway, start with a nice uptrend. We made a minor double top, and then it sold off fairly hard. Now, this is kind of a TKO, and that's what I published it as when I made the recommendation. And it's kind of a TKO over a couple of days, so kind of use your mind's eye and kind of blend the bars together. I guess a 3-day chart would probably show a little bit better the knockout type of move. And it's also kind of a double top knockout. We have a minor double top that's like you get a little peak, couple little 2 or 3 days of trading in between, or 3 days I think is ideal, and then another little peak. And minor little double top like that makes people think that the market might be topping out. The eager shorts are usually sucked into something like that. And if the market has a TKO move, trend knockout move, it tends to shake out the nervous Nellies, the people who buy late in the game, the people buy those brand new highs, think it's going to go up forever. And I'll talk about buying highs in a minute. There are times when you can actually do that. Anyway, so nice little knockout move. There were all the parameters based on a hypothetical 100K account, although I do take the trades, as I'll show you in 1 second. Entry was there, stop was way down here, the IPT was up here. So it's a near miss on the IPT, which called for a little bit of discretion, and we'll talk about that right now. Using a little bit of discretion. Keep in mind, discretion is not throwing caution to the wind. It's not abandoning the plan. I remember one time I had a stop on a stock, and it was at 9, okay? And the stock was doing fairly well, and it came down and it hit that stop technically. But when I looked at the time and sales, I really didn't see any significant trading there. I think there might have been 100 shares hit, if that much. And I don't know how that print of 899 got on the chart, but technically and mechanically following my plan, you would have been stopped out. Now, I personally didn't exit on the trade. A little stop nick like that, that's kind of an obvious form of discretion. And you don't want to throw caution in the wind, of course. But anyway, I remember doing a webinar on it a week later, and someone said, well, how come you didn't have the stop set at 899? And I'm like, well, nobody's that good, okay? So, I mean, I'm good, but I'm not that good. So that's why sometimes these IPTs could be missed by just a few cents, because you don't know exactly where the market's going to go. I thought it had the potential to go there, but obviously it didn't quite make it. So anyway, there's the chart again. So we had a near miss. 31.25 was the IPT. Now, when it comes to these discretionary calls, there's a few things you need to ask yourself. How far has the market moved, okay, and how fast? Now, if it's fairly close to the IPT, and especially if the markets move really fast, in this particular case, it's 1, 2, 3, 4, 5, like 6 days, 6 trading days, and you're already to the IPT, and that's fantastic. That's a pretty quick move. You know the market's already oversold when that happens. So that's when you need to think, okay, I don't quite have that IPT, but I think it's worth taking. Don't look the gift horse in the mouth. And of course, how close are you to that IPT? So how far would be how far the market has moved over how fast. So those two kind of work together. So in this case, it was about 4 points, I guess, or 5 points, five or 6 points in 5 days, 5 or 6 days. That's pretty significant move for a $20-something stock, like a 20-30% move over the period of time. So don't split hairs when that comes to this. Now, I noticed on my exit, I did exit when it was right up at that peak. It didn't stay there long, so it would have been tough to get really, really close to the IPT. But what I did do was I mentioned to my Facebook people that, hey, this thing is close enough. Let's think about getting out. And then unfortunately, the stock had come in a little bit, but by the time I exited. So, and I was a little late on the entry on this one. I guess I wasn't paying careful attention. I didn't have my alarms or alerts set properly, and a lot of times I'll use a stop entry order, and I didn't have that set. So I got a little bit of it's not slippage because it's my own mistake, but I didn't quite get in right where I'd planned. Anyway, so on the trade, I made 390 on half. Okay, so instead of making a full $1,000, 1% on the entire account, right? And this is from my model account. I have an account where I model the trades out. I also take the trades in other accounts, but just for the educational purposes, I like to show the actual trades and how I played them personally, good, bad, and indifferent. So you'll see that, like in a second, I'll show you something that fat fingered, just to show you that, hey, we're all human in this game, and sometimes we're not absolutely perfect. Anyway, so I'm okay with that because the money is on the second loaf of the trade, and should this trade stop out, at least I was able to get something out of the trade. Anyway, here's another one. This is an update. Now, one thing I was thinking about before I went live, and I added a couple extra lines to these charts. When you're looking at a setup, you want to put as much of the bigger picture behind you. As I've said before, I knew a day trader once, and he would look at monthly charts and weekly charts and daily charts, even though he was only in there, I guess you'd call it scalping, over a very short period of time. In some cases, I think he held a little bit longer. But he made sure he had as much behind him as possible. So I always remembered that. And that's a big part of the swing to intermediate term trading I'm doing. So most of my setups are pullbacks or pullback related, such as the TKO and things of that nature. Classic Dave Landry there. But anyway, it is important to look at the bigger picture, okay? And so, and a lot of times bigger picture technical analysis, as I preach, you don't necessarily want to rush out a trade, bigger picture technical analysis in and of itself, but it works as a really good backstop behind your trade, okay? So in this particular case, the stock makes all-time highs, comes back in a little bit, tries to make all-time highs again, and then comes back in once more and trades mostly sideways for a significant period of time. It then makes the bow tie to the downside, going from uptrend proper order, 10 greater than 20 greater than 30, 20 and 30 are exponential, 10 is simple, to downtrend proper order, 10 less than 20 less than 30. That's illustrated down below, okay? Now always look at your charts, even if you have the best indicators in the world like I do. Make sure you're looking at your charts. So you can see the bow tie was a little bit sloppy, but that's okay. I called this one a first thrust, and first thrust is when you have a sharp thrust down, especially after it kind of tops out like this one did. Now remember, and I don't want to talk too much about this because I think I say it every week, but my brand of technical analysis, the way I look at technical analysis, is you're looking at the charts to read the psychology of the market players, okay? So at brand new highs, everybody's happy. When the market begins to drop, those people who bought at those new highs are beginning to lose money. And then the further it drops, the more you go back in time, people like back here, for instance, are beginning to lose money. So that's a lot of trading and a lot of people possibly looking to get out of the market. Now, a lot of times people won't sell on the way down. This is something I was talking about not that long ago. What they'll do is they'll wait to see if the market rallies. And that's why sometimes the pullbacks work fairly well on the short side, is because the market begins to rally and people begin to sell into that, and that selling starts to hit the market, and the market sometimes rolls right back over out of that pullback. So those pressures get greater and greater as the market drops further and further. So again, remember there's a psychological backing behind everything that I do. And by the way, it needs to be conceptually correct. I was watching a video from, these little kids pop up on YouTube, and yeah, I've been trading for 2 years, and I'm the greatest trader in the world, and I'm blah, blah, blah. And I was a little shocked that one of the guys was doing something that was conceptually correct. I'm like, well, wait a minute, he might be onto something. But anytime I digress, I know. But anytime you look into something or think about doing something in the market, just make sure it's conceptually correct, okay? So on corrections, certain things happen, like the TKO. Let's talk about uptrends for a second. In an uptrend, you have that knockout move that knocks out the nervous Nellies. It attracts eager shorts, okay? And the selling of those two kind of pushes the market down, but all of a sudden the market goes right back up. Sometimes those people who are buying at the new highs might buy back in. The shorts might be forced to cover, but in a lot of cases, the shorts won't cover right at this new highs. They'll wait to see if it keeps on going, and they might get squeezed out much further. And that's how these markets sometimes go parabolic. Anyway, I didn't want to go into a conversation just about TKOs, but I want you to understand that it's the psychological backing in the bigger picture technical analysis that's very important when it comes to trading. Anyway, entry was there, stop was up here. It kind of went for us a little bit initially, and then it turned right back up. There's an old market adage, all shorts will go against you initially, and boy, it sure does seem like that is the case quite often. But anyway, we did hit that initial profit target. At that level, we take half, and the stop is brought down to break even. In this particular case, because the market dropped a little bit further, we did drop the stop a little further, and we got stopped out on that one on yesterday, or yesterday, I should say. Actually, it was the day before. Anyway, this is what it looked like. That's the first loaf. And the second loaf, unfortunately, we only made a little bit of money on that. Now, in an ideal world, that second loaf runs for a long, long, long time. Maybe the CCL right here, which we'll talk about in 1 second, which is looking a little bit better in the second loaf, that one might pay off. So you're trying to, as I often say, you're trying to catch that initial profit target, and that keeps the lights on. And you have to, no matter what type of trading you do, I'm a firm believer in the fact that you must position yourself for the potential for longer term gains. In fact, the secret to trading, if there is one, is establishing free positions, because sooner or later, one of those free positions, free rolling, as we now call it, could turn into the mother of all winners. And that's what we're playing for, those occasional outliers. Anyway, here's the options trade. I'm not going to spend too much time on this because we talked about it in weeks prior, and I found I got myself pretty confused when I tried to relive all what I did here. But the bottom line was two things. One, you can buy deep in the money puts as a substitution for stock. So in this particular case, in order to short 200 shares, I would have to put up $15,000 of margin, okay? And in this particular case, I was able to get a couple of options for $930. So my risk went from 2% to 1%. Now it's a little bit more complicated than that because you got to roll down, you got to roll out. There's all kinds of other things. And as I say, options, lots of moving parts. The other cool thing that I think it's cool that I was able to do is before I put up that $930, I noticed that these slightly out of the money options were only trading for 25 cents, okay? That's $25 a contract because it's 100 shares. And I figured before I put on my deep in the money puts and put up $1,000, round numbers, I would take this little trade for $50, okay? And you got to be careful, I know, because you can't get a little bit pregnant, right? But I figured that at $50, okay, if it doesn't work out today, I could sweep it under the rug and then figure out my positioning. And fortunately, it did work out, and I forget the math. I think it was $140 if we add all that up for a day trade. So that kind of helps to, and again, keep the lights on. Now, there were lots of other things in here like roll downs and all, and the spread experiment I talked about last week. Spread experiment, it worked, but what I didn't like about that was I wasn't sure what to do as far as like hope, not that you should base your trading on hope, but it's like, well, what do I want this position to do? Well, I want it to go down because I have a long put, but I want it to go up because I have a short put. So ideally, I want it to go up for a little while, and then I'll cash out of my put. Then I want it to go back down. And before you know it, it's like you're wanting all these different things, and you're putting yourself into a state of regret, a potential state of regret, or state of confusion, however you want to look at that. So not a good thing. And then I did some fat fingering on one. Fortunately, it only cost me literally $5. And rollouts and exits. Now, after all, I did all this stuff. I still have one put left over. So even though we're stopped out on the outright position, I have one put left over, and we'll see how that works out. It's going to expire in a couple of days. There's all the trades if you want to take a look at them. And again, if you go through last week's, or it was 2 weeks ago, weekend charts, I went through I think nearly all of that trading explained how everything shook out. So a lot more stuff that. But anyway, the main thing there to know is options as a substitution for stock, especially on the short side, can work out nicely. Now, can being a keyword in that sentence, I would imagine now that the implieds have gotten so out of control, it's going to be a little bit harder to make it work. But if you go deeper and deeper to the money, some of that fluff, so to speak, the extrinsic value should come off of the options. All right, here's the mystery chart. Here's the mystery chart follow-up. And again, you know, like I said, right before we went live, I drew a few extra lines on the chart. Now, just real quick to back up for a second, we've got the proper order illustrator down below, and it's nice and green here, okay? It looks fantastic, but you also need to look at the chart. What's the chart doing? Well, you can see the chart begins to lose steam. It did try to make a new high here, then it came back in, and the net move is nil to negative. So it really wasn't doing so hot, okay? Then it shoots up to all-time highs, like, okay, well, maybe it's breaking out again. And then nope, it rolls right back over, okay? So once again, you've got that bigger picture backstop behind you, that bigger picture technical analysis backstop behind you. The market is rolling over, making a big top. That's further confirmed by a bow tie. By the way, the bow ties, the designer intent for that was to catch a more gradual rollover in a market. And what's amazing, and I know I'm a nerd, but sometimes you can get a signal fairly early into that rollover. Now, if you're into classical technical analysis, obviously this looks like a bit of an inverted saucer and handle or inverted cup and handle. And that's, again, bigger picture technical analysis working for you. Anyway, entry was here, stop was up here, IPT was down here. When the IPT is hit, we bring the trailing stop to break even on the remainder. So barring overnight gaps, which do happen, unfortunately, but barring overnight gaps, the worst you could do is break even on a trade. And now you're free rolling, so to speak, and you have the potential for a longer term home run. And that's where the money is. Anyway, the stop has been trailed down a little further. And just by the way, I don't know to say this quite often, but on that second loaf, that trending loaf, which hopefully turns into a longer term trend, you begin to loosen that stop up over time to ride out deeper and deeper and deeper and deeper corrections, okay? And a lot of times it's by doing nothing. Let's say the market moves 25 cents in your favor. Well, you just leave the stop where it is, and now your stop is widened by 25 cents. I call that keep the change. The other thing that I often do, let's say a market moves $3 in your favor, which is great, right? Instead of moving that stop down $3, I might only move that stop down $2 or up $2 for longs, obviously. And I call that gaining ground. So you're gaining ground. You're not gaining ground on a one-for-one basis, but you're giving it more and more wiggle room to possibly correct and keep on riding. Now, I've written out some ugly corrections, and then the market has turned back up. Fortunately, I've also written out some ugly corrections and gotten stopped out. You kind of have to take the good with the bad. When that happens, as I often say, all trades will eventually end badly. You have to look at how much you made on the trade and not how much you lost, so to speak, on the drawdown. So drawdowns are open profits, and I've said this quite a bit too. Dennis and Eckert, and I think it was Dennis, and it was one of the turtle books, and I want to say it was written by Fate. Well, that's the only turtle books I've read. That's the only one I'm only going to read a book about somebody if they were actually part of the program. That's kind of my feeling on those turtle books, as opposed to the people that try to capitalize on what they did by writing books about them. Anyway, that's a whole nother story there. And I'll probably get myself into trouble if I express more feelings. But anyway, long story endless, it was Curtis Faith that said Dennis treated open profit drawdowns a lot differently than just flat out open losses. So if you had an open loss in a trade, he would look at that pretty hard, like, okay, why are we not getting out on this? Where's your stop? Did your stop get hit? What's going on? And he put the trader under a lot of scrutiny. But if you had an open position that you were making tons of money on, and it drew down significantly, as trend following will do, and that's one of the parts That's one of the things that they don't tell you in the brochure, right? That occasionally it sucks, but it does happen, and that is part of the game. And that's why you can see this case here. The open profit drawdown, if we hit this stop, would be significant. Go back to that TPR. That was a lot of money to give up. And believe me, that kind of sucks, right? But it comes with the territory. And if you're going to catch any longer term trends, okay, you have to be willing to give up some open profits. Anyway, so there was $1,000 on the first loaf, and that's based on a mark to market on the second one. So not much more than $1,000 so far. Let's just see how it all shakes out. Okay, now, as I was putting this presentation together, I got to thinking something I hadn't said in a while. And a lot of the presentation is based on, for the TFM 10% stuff, is the fact that it only works because you're avoiding the occasional diaper change moment. That's occasionally when the market gets absolutely whacked. And when I designed that system, the idea was to get you out of trouble before things really got nasty. And knock on wood, you would have avoided every bear market in history. And I keep forgetting when I first published it, but it's probably been out, I don't want to exaggerate, but maybe 10 years? I don't know. It's been out for a while. And fortunately, so far, so good. But market timing is less about beating the market and more about not letting the market beat you. So the only reason, again, something like the TFN 10% system works, or any other market timing for that matter, is because occasionally the market has a 50% or more haircut, okay? And getting out of the way for the majority of that does help your longer term performance versus buy and hope. Anyway, so this little arrow here needs to be dropped down to there, okay? So it's 2 bars of Landry light, and then you enter on the close. So that needs to be fixed. But anyway, there's the rules. I'm not gonna spend a lot of time on this because we talk about it quite often. The only thing I do want to show you is that we did have a recent sell in the S&P 500, and so far we're back above those levels. Now, it was very hard for me to take that sell signal. Now, if I take the sell signal, all I'm doing there is I'm pulling my girls' leftover college funds, and I'm resisting getting in there and doing a lot of trading with them, and the accounts they're in, I can't do a lot of that anyway. I don't want to just leave it all alone. So what I'm doing is I'm just using a little market timing to get them out of the way. I think I've only pulled them once before, and that was right around the pandemic. Maybe once before that. I have to think about it. But anyway, so it was hard for me to sell on that day because I'm like, this market is so oversold. Maybe a lot of this stuff is just news related. And I did a lot of confusing the issue with facts, and I'm like, nope. I've got to follow the system. I've been following the system for quite some time, and I'll keep following the system, knowing that the market might bounce right back. Okay, well, shit happens, okay? That's just the nature of following a system. Anyway, here is a spreadsheet going back to the 20s, late 20s. And if you look at the diaper change is how much the market dropped after you got out, which is pretty amazing if you think about that. So in the 20s, late 20s, you got a signal before the depression really kicked in, right? And the market lost 83% of its value afterwards. And you know, you start talking about market timing, people are like, well, that was then, this is now. It's like, well, hang on a second. The NASDAQ lost 70-something% of its value back in 2000. People don't realize that. Just go in and look at the charts if you're ever confused about this. And I've told people before, as I mentioned in one of the books, it's like I explained to them, they talk about, oh, well, it'll always go back up. And I'm like, well, that might take 25 years or more. And they don't believe me. It's like, okay, well, just, you know, look at the charts. I'm not going to argue with you, especially if I'm getting free drinks at a cocktail party. But anyway, there could be some really ugliness, and there could be some extended periods where the market does not always go up. And and I don't want to digress too far, but, and I know I've said this before, but a lot of these people who make good money being money managers, okay? Because I talked with a friend of mine a while back. He had another friend of his that was a money manager. He's like, okay, we're gonna put you in this or whatever. And so he gets his portfolio, and he thought it would be like all this stock picking and all these things going on, and they just put him in some fun and forget about it. And his friend has moved on to find more clients. So they're more asset gatherers, and God bless them. But I think the reason they can have decent careers and retire, is because you could have a pretty good run. You could have that 25-year period where the market goes higher. And by the way, I saw someone recently, and maybe he's got a good argument. I don't know. But his argument was there's never been a 30-year period where the market wasn't higher than where it started. I'm like, okay. So his point was that if you had a young person, kind of like my daughters are, they're still pretty young, maybe I should just leave them in with the buy and hope. But the trader in me won't let that happen. And if you think about it, how many 30-year observation periods do you really have from a statistical standpoint? I don't know a lot about statistics, but I do know, well, I know statistics are worthless. 75% of all people know that, but I think that's Bart Simpson. But anyway, I don't think that's enough observations. If you observe something, once or twice, that's not necessarily observation of everything there is. My parents were kind of like that. If something happened to somebody once, then it was like, okay, we must, that could happen to anyone or whatever. It's like, well, it could, but the odds are pretty low because you just have one sample you're looking at. You don't have a bigger picture sample to look at. Anyway, I don't think the sample size is big enough, is what I'm trying to say. Show you how little I know about statistics. But markets aren't normally distributed. We have these so-called fat tails. That's why statistics don't work in markets. Anyway, you can see pretty serious diaper changes in here, 20, 30%, 40%. And then we had 44% and then 52% in the last couple of bear markets. The pandemic signal, if you look at that signal, it got you out, okay? Like here, the market dropped hard, okay? And then it came back up and got you back in here. So it actually got you back in higher than it got you out. So technically, right, that was a whipsaw. That was a wasted trade there, but not so much. As I've said 100 times, I had a friend of mine, and he was near retirement, and it was killing him every day. That market went down further and further and further and further. I would imagine he would have slept a lot better and wouldn't have aged as much, knowing he's that close to retirement, if he'd have gotten out and gotten back in and maybe took a small haircut overall, as opposed to trying to live through a 30% drawdown. So it happens, but again, market timing is less about beating the market and more about not letting the market beat you. Now, so far, I was a little surprised at this number. I thought it would be a little smaller, but so far from the exit, the diaper change moment, now that's the low, okay, has been 5%. So a 5% drop in something like the S&P 500, that's a fairly significant drop. Anyway, so here's the diaper change moments. And you can see the 70s. The 70s were abysmal. I was not trading then. I do have one or two clients that were, and I respect them a lot because I can learn a lot from them. Anyway, you can see that's crash of 87. And again, every single bear market would have gotten you out roughly at about 10%. Now, this last little signal, the losses were a little bit more than 10% because of the way I did the research on a calendar basis. So you don't exit until a Friday, which that might bite me down the road. But I didn't want to change a system during the heat of battle. As Greg Morris says, that's the worst time to change a system. So far, so good with the system, so I'm continuing to follow it. There's a 2000 bear market, and there's the 2007, 2008 bear market. You can see the market dropped 50-something percent, 55%. And that's for a 50-week high. If you go back a little further, it might actually be a little worse. So that's That's pretty ugly. And again, anything above this 10% for the most part, for all intents and purposes, you would be out of the market given the system. That was kind of the whole idea. And then we had a little spill back in, was that 2019? That was the COVID one. And it doesn't look like it, but if you look down here, you can see that's a 30% drop-ish, okay? And that's a significant drop. To lose a third of your money over that short a period of time, especially if you're near retirement, that's not a good thing, right? Now we're with the question mark, okay? How far will this signal go? I hope it's a whipsaw, okay? It might not be though. So this was a signal to Qs. Again, we talked about this ad nauseum, so you can go back and watch the weekly charts on that. Now this one was kind of cool because it gave us a little bit, this is kind of like the designer's intent. I want to be out right around that 10% line, okay? Now my whipsaw filter, the 50-week moving average, can sometimes muck that up a little bit, but it does often keep you from chasing your tail by getting out and then getting right back in. But anyway, this one's held a little truer to the designer's intent of avoiding the diaper change. So it's only 3%, but that's 14.20 points. In this case, only had 100 shares on, but that's still a $1,400 drawdown. That's good money. So far so good there on that. Any questions on all this? I'm kind of rushing through it all. All right, the Landry 100. I'm simply just buying stocks as they're making new highs. Unless you're in an inefficient market like crypto and everything's going straight up, I would recommend you not just buy new highs, or if you're going to buy about 100 of them, okay? And we haven't fully fleshed it out, and I don't know if statistics again would be valid, but maybe there's a number smaller than 100 that would be big enough to make this work. But I figure with 100, you only have 1% in each stock, so if one of them blows up, as they occasionally do, not a whole lot of harm is done. But if you're only doing a few of these and they blow up, then you're in a lot of trouble. And I think with 100, it guarantees that you occasionally will catch a home run. So even in this crappy market, this little biotechnology, okay, again, we're buying at brand new highs. It's had a pretty good run. Now notice that it did have a pretty serious drawdown, okay, after we bought. And that's what happens a lot of times when you're buying new highs, is you end up, buying the high tick of the day, of course, and then the market comes back in. But so far so good, up 230% on this particular one. Now again, this is like a proof. This is a proof of concept. It shows a lot about momentum, how momentum can occasionally end badly. I have no money management in here. If I was doing this with real money, and I did a little real money experiment with it, I am taking profits at 100%, partial profits at 100%. But if I were to someday run some sort of bigger money on something like this, I definitely would put some money management in. But in order to keep everything pure and just play the momentum game, kind of the proof of concept again, I don't put any money management in. And when things start, when these particular stocks start looking a little ugly, I take them out of the list. I also treat cash as an asset class. You can't see it, or you squint your eyes, you might. I think there's 70 stocks in here. So as they're stopping out, I'm not finding as many new stocks to go in. And so the list is beginning to become smaller and smaller. And what could eventually happen is you could end up mostly in cash in a bear market, should that happen, God forbid, right? Anyway, another cool thing about it is you can see gold stocks, okay? Well, what's hot lately? Gold. About the only thing that glitters is gold, right? Lately, at least. There's some defensive stocks in there, such as beverages, some kind of boring, it's like, oh, I don't really want to put like a Coca-Cola or whatever in here. But it's like, well, that's the only thing that's going up. Let's just continue to follow the little idea here and see what happens. And then there's a couple of biotech stocks in here. And biotech sometimes is one of those areas where they can have some sort of excitement in the sector and individual issues, especially, not so much the overall sector, which is not performing well. We'll take a look at that in 1 second. But there can be some excitement in some of these companies, and they can trade contrary to the overall market. And down there's some grocery stores, something you probably won't get rich on trying to trade, but it's the only momentum that's out there. Now, one thing I would caution you, and I know I'm showing you this momentum list, one thing I would caution you on is playing the relative strength game, unless it's something like a crazy biotech, like the TOI, it's going straight up, or gold stocks. But in general, you want to be careful chasing relative strength in a down market like we are in now. Anyway, just a few random thoughts we talk about each week. Random thoughts would be momentum ends badly. Relative strength in a bear market is okay, but they eventually will find you. So those grocery stores and those defensive stocks in here, I'll probably eventually be taking them out at a profit or a loss. I don't know. Maybe a loss. That just, it seems like it happens. But something like gold possibly can run a lot further, especially if the bear market continues. Again, it's a great way to see money flows, and cash is not trash, and that's why I treat it as an asset class. That kind of rhymes, doesn't it? Anyway, we had a recent loss in the S&P 500, and also the Qs, and also the Nasdaq, and we can look at those on live charts. Death cross is just simply the 50 dropping below the 200-day moving average. Media gets all excited for the death cross. It does have some merit, but it doesn't have merit as far as a mechanical system testing out. So the golden cross would be 50 coming back above. So if you bought and sold based on the crossings of the 200 and the 50, and I think Rob Hanna, I talked to him a while back on this, is a very slight edge. It's not a tradable edge. It's like a 4% edge, not worth it trading. However, with any momentum indicator like bow ties or the TFM 10% system, as far as getting out of the market, Landry light, and all these other great things, the magnitude of what can happen based on that momentum indicator can be substantial. So I put the diaper changes down below here so you can see how far the market has dropped from its peak. Now, the death cross wouldn't have gotten you out. Might have been a little late to get you out in something like the pandemic or whatever, because of that's such a spike lower. And I'm not saying use a death cross for timing. My point is that it's the magnitude of what can happen below that death cross that's important. You could have a 50% haircut or more below that, or any other type of momentum indicator. So obviously we have the recent death cross, and we don't know where that's going to take us, but it's worth noting.